So let us start with the further explanation. Evaluation of the appropriate method for the identification and management of the financial risk. That is the next thing that we are going to learn. Appropriate method for the identification and management of the financial risk. So appropriate methods for identification and management of the financial risk. So methods with which you can identify that there is a risk, and management. So there are two things: method of identification and the second is the management. As we have classified the financial risk in four categories, we shall discuss the identification and management of the each risk separately under the following category: counterparty risk, political risk, interest rate risk, and currency risk. So friends, initially whatever the financial risk that we have studied, for that they are giving further explanation. Before we read that, so let us have a small revision of this portion. Financial risk is referred to as unexpected changes in the financial condition, such as the prices, exchange rate, credit rating, and interest rate. Though political risk is not a financial risk in the direct sense, but the same can be included as unexpected political change in any foreign country may lead to counterparty risk, which may ultimately result into the financial loss. So over here they have added something like this called political risk. With that, so there is counterparty risk, and with that, so there is a financial loss. As far as a political risk is concerned, that is the change in the central government, state government, change in the government policy. Accordingly, broadly, the financial risk can be divided into following categories: counterparty risk, that is somebody to whom you already have made the payment, and so that supplier is not supplying goods to you, or otherwise you have given bank, that is loan as a bank, and so the borrower is not making repayment to you. Political risk, which we have just discussed. Interest rate risk, when you borrow at the floating rate and the rate of interest is going up. When you borrow at the fixed rate and the floating rate of interest is going down. When you have invested at floating rate and the floating rate of interest is going down. When you have invested at the fixed rate and the floating rate of interest is going up. These are the four, like the risks that we understand. And the currency risk, the currency in which you have borrowed and that currency is appreciating. The currency in which you have invested and that currency is depreciating. In foreign exchange risk management, we understand that there is a transaction risk, there is a translation risk, and there is an operating risk. These are the three major risks that we have. This risk occurs due to non-honoring of the obligation by the counterparty, which can be failure to deliver the goods for the payment already made and vice versa. Repayment of the borrowing and interest rate and interest. The risk also covers a credit risk, that is default by the counterparty. Generally, this type of risk is faced by the overseas investor. We have discussed the example of the Amazon making investment in India, and they have this kind of risk. As the adverse action taken by the government of the host country, suppose Indian government is taking any action, so it is adverse for Amazon. may lead to huge losses. Confiscation, destruction of the overseas property, rationing of the remittance to home country, that is say from India they cannot take money to United States, restriction on the conversion of the local currency of the host country into foreign currency, restriction as a borrowing, invalidation of the patents, and the price control of the product. Interest rate risk. This risk occurs due to change in the interest rate resulting into change in the assets and the liabilities. What happens at say we understand that the technically valuation of a security is depending upon say the market rate of interest. So if at all the market rate of interest is changing adversely, then in that case value of your investment will fall down. That is the investment that say you have made. The risk is more important for banking companies as their balance sheet items are more subject to are more interest sensitive. For a bank, base of the earning is spread between borrowing and lending rates. Means the difference between the rate at which the bank is borrowing and the bank is lending. The interest rate are of two types, fixed and floating. The risk in both this type is inherent. That is, in fact, if at all you borrow at fixed and the floating rate of interest is going down. If you borrow at floating and the floating rate of interest is going up. We are talking about the risk, so I am talking only about the adverse change. If any company has borrowed money at the floating rate, then with the increase in the floating, the liability under the with the increase in the floating rate of interest, the liability will increase, and under the fixed rate it is going to remain same. So they have provided explanation. This fixed rate with the falling floating rate, the liability of the company to pay interest under the fixed rate shall be comparatively higher. So if at all the floating rate of interest is falling down and you have borrowed at the fixed rate, then in that case your interest liability at the fixed rate is going to remain same. To cover such kind of risk, there are concepts like interest rate swap. Swap means interchange. Interest rate cap, wherein you have entered into a derivative transaction in which there is an opposite party who will bear the excess interest cost that is beyond the exercise rate of interest. This is say covered in your chapter of derivative interest rate risk management. Of course, you are required to pay some amount of the premium set to buy this kind of right. Interest rate floor. This is the kind of agreement which a lender will enter upon, which a bank will enter upon. Then whatever the interest income that it is going to receive is also subject to the fluctuation, is subject to the reduction. That is the reason so you may enter into this kind of contract to have a protection for the minimum interest income. Again, you are required to make the payment of the premium set to get this assurance. FRA, forward rate agreement, at which you can fix the borrowing rate or you can fix the lending rate. Interest rate futures, again it is similar to the FRA with the difference in the execution of the transaction. Interest rate collar, wherein you have a combination of the interest rate cap and interest rate floor. So your interest will be say within a specific range. Neither it will go below a value and nor it will go above a value. Next, the currency risk. It is form of the financial risk that arises from the change in the price of one currency against another. Whenever investor or companies have assets of the business operations across national borders, they face currency risk, or it is given a name as foreign exchange risk, which we study in detail in our very simple chapter of foreign exchange risk management. This is an example wherein it says that say if at all you have invested in a foreign country and the security is gaining, let us say by 15%, but that currency is depreciating by 15%. then overall your return is zero. So US investor made investment in Canada, there is a 15% positive return in the stock, that is in the security. However, the Canadian dollar depreciates at 15%. So ultimately the investor will have no profit, no loss. This is what we already have discussed. So coming back over here, appropriate methods for identification and management of the financial risk. As we have classified the financial risk into 4 categories, we shall discuss identification and management of the each risk separately under the same category. Counterparty risk, political risk, interest rate risk, and currency risk. These are the 4 risks that you have. Counterparty risk discussed in detail. The various hints that may provide counterparty risk are as follows. Failure to obtain necessary resources to complete the project or transaction undertaken. Any regulatory restriction from the government. Hostile action by the foreign government. Let down by the third party, or they have become insolvent. So these are what we understand is the hint that provides that the counterparty will not be able to survive, or it is not going to meet with the transaction commitment which they have given to you. In a way that suppose as a bank you have given loan to someone and you find that that person or that company is having one of this like the features or is having one of these situations, then in that case you will have the counterparty risk. If at all you already have made the advance payment for purchase of the goods and that counterparty is having one of these things, then in that case you have to understand that there is a threat to you for getting the goods from the supplier to whom you already have made payment. Various techniques to manage this type of risk are as follows. So identification is done. Now how to manage, that is what they have explained us. Carrying out due diligence before dealing with the third party. So you properly verify the past records of that company. Do not overcommit to a single entity or group or connected entities. So importantly, we understand that as a bank, if at all I am giving like the huge amount of the loan to a specific group of the companies, then that group of the companies their performance will be very important for your survival. That is the reason you should not overcommit to a single entity. You should know your exposure limits, review the limits and the procedure for the credit approval regularly. If at all you have sold goods on the credit and that customer is not making payment to you, is also the counterparty's risk. And at the same, that is for this you should always review the credit limit to be given to a customer. Rapid action in the event of the likelihood defaults. You should be very prompt once you have the signaling from one of these features. Use of performance guarantee, insurance or other instrument. So you may use these things at the time of entering into the transaction. That is when you are selling goods on the credit or when you are making advance payment to the supplier, something like that. Now with the same slide, appropriate methods in that political risk. Following actions by the government of its host country, this risk can be identified. So over here they are focusing that if at all you have made investment in overseas and said that host country is like the government of that country is doing something like this, then in that case you have to understand that you are at a risk. insistence on the resident investors or labor, restriction on the conversion of the currency, repatriation of the foreign assets of local government, price fixation of the product. So how can you overcome this? By referring political ranking published by the different business magazines. This is very important. We understand that say we should not make investment in the countries like Taliban, Afghanistan, something like that, or like Tanzania or Uganda, somewhere like this, because over there, so the political, say the situation can change at any point of time. Evaluating the country's macroeconomic condition. If at all you find it proper, only in that case you should make investment. By analyzing the popularity of the current government and assess their stability, this is very important. Whatever the current central government is there and how far it is likely to remain, say in future. Taking advices from the embassies of the home country in the host countries. So we understand that say if at all we are going to undertake a project in Australia, then in Australia we will be having say our embassies. So we should take an advice from them before we start our business over there. Further following techniques can be used for mitigation of the risk. So these are the techniques for the purpose of mitigation. Local sourcing of the raw material and the labor, entering into joint venture, local financing and prior negotiation. So we should be having say something like this so that say we can avoid say the political risk. This is what say we understand is a method of the mitigation of the political risk. Next, now interest rate risk. Interest rate risk is what we have discussed in detail if at all your chapter of the interest rate risk management, which is covered in the derivative is completed. So first of all, that's how can you identify the interest rate risk? Monetary policy of the government, any action by government such as demonetization, etc., economic growth, release of the industrial data, investment by foreign investors, and stock market changes. So they have provided over here say only say the identification of the interest rate risk. For the mitigation they have not provided anything over here, but all those things have been detailed discussed in the chapter of the interest rate risk management, as they had provided a list of interest rate cap, interest rate floor, collar strategy, forward rate agreement, swap transaction. These are the transactions in which you can enter upon. And the next is a currency risk. Currency risk. Just like interest rate risk, currency risk is dependent on the government action and economic development. Some of the parameters to identify the currency risk is as under. One is the government action, second is the nominal rate of interest, third is the inflation rate, fourth is natural calamity, fifth is war, coup, rebellion, etc. Sixth, change government. So here, so they have provided that, so how can you identify it? Action of the government. Government action of any country has visual impact in its currency. For example, United Kingdom government decision to divorce from EU, European Union, that is Brexit, brought the pound to its lowest since 1980s. So the pound currency was devalued from say the year 2000, that is say 1980, say to the point at which say it took divorce from the Brexit. We know that say the Brexit was like a kind of action which the UK government had taken, because of which say as far as the European Union, those countries that say they were having say the free trade contract, say they would not be having such a free trade contract afterwards. That is the reason, say, the pound currency depreciated a lot. Nominal rate of interest, and this is very important, as per interest rate parity, the currency exchange rate depends upon the nominal interest rate of the currency. Friends, as far as the forward exchange rate is concerned, which we study in our the foreign exchange risk management, it is spot plus interest on left hand side currency divided by 1 plus interest on right hand side currency. Wherein you can understand definitely that say the interest rate is going to be say very important in this situation. So we understand that say with the change in the rate of interest, so the exchange rate will keep on changing. This is what say we have studied in our chapter of foreign exchange risk management. If at all you have exported goods and say that currency is having constantly increase in the rate of interest, then in that case that currency will constantly depreciating, and whatever the foreign currency receivable is, what you are going to receive is going to be less. So with that say you will be having say the transaction risk also. That is what say they're explaining over here. Next is the inflation rate. Again, dear students, for the purpose of calculating the forward exchange rate using purchasing power parity theorem, it is spot plus inflation on left hand side currency divided by 1 plus inflation on the right hand side currency. This is the way the forward exchange rate is calculated, and in that we understand that say the inflation is again going to be very important. Same example, if at all you are exporting goods to a country whose inflation rate keeps on increasing, then value of that currency will keep on falling, and because of that say the foreign currency receivable that say you will have the less value. So you have the purchasing power parity say theorem to be applied to understand this. Next is a natural calamity. Of course, so that is also going to have an impact. Any natural calamity can have so the negative impact. If war, coup, rebellion, etc., all these actions can have far-reaching impact on the currency exchange rates. If at all there is a situation of war, or say within that say political changes are there, or if at all that say the local public is having say some opposition say for the central government, then all these things will be having say the impact on the currency risk. Change in the government is of course going to be there. Change in the government and its attitude towards the foreign investors, and also helps to identify the foreign, that is say the currency risk. We know that say 1991 to 1995, when P.V. Narasimha Rao was Prime Minister and Dr. Manmohan Singh was like Finance Minister, at that time, so the India had opened its market say for all over the world. Since then, so it was allowed that so you can come in India for the purpose of doing business. So whatever the government policy that was changed since then, so that has an impact even today. And of course, initially it was not so much open, but so that was the starting point. So whatever is the government action like this, say will have an impact on the currency exchange rate. So friends, let us have the quick revision of the things that we have done. What we are going to have the learning in this chapter is identification of the types of the risk faced by an organization. In that, strategic risk, the basic decision based on which you are going to do business. Compliance risk, in that it is a legal matter, whatever the rules and regulations that you have to follow. if you do not follow it, and you are required to make the payment of some penalties. Operational risk, proper internal control is missing, and because of that, there is a fraud. Because of that, there are a number of mistakes. You are not able to give service to your customers. Financial risk, that is what they have discussed in detail in a way that it is given the most importance in the entire chapter. That is what we understand is the first identification of the types of risk. In the strategic risk, they have given two major examples. One is of the Nokia company, another is of Kodak company. Third, they have given a good example of the Xerox company also. It is because of the technological changes, new competitor entering into the market. Jio is the best example, entering into telecom sector, and it had an impact on the other companies dealing in the business. That is that line of the business. Shift in the customer's demand, increase in the cost of the raw material, any number of the large scale changes. In examples, Kodak company, Nokia company, Xerox company, and of course the Jio can be added to it. Compliance risk, in that you do not meet with the rules and regulations, and because of that, you have to pay penalty. That is what we understand is the compliance risk. Example that they have given is of the Kingfisher. Next is the operational risk. It is related to the people, related to the process. So you pay 1 lakh instead of 10,000. It is a weak internal control system. So you should segregate the duties. That's very simple. Financial risk, that is the most important for this chapter. And this is what recently I have discussed with you. Prices, exchange rate, credit rating and interest rate. These things are changing, and they have divided into like this: counterparty risk, political risk, interest rate risk and currency risk. As I already have told you for a number of times earlier, that these head points are extremely important. Recently I have explained all these things to you, rather we have gone through it for all these four risks. In the political risk, we have to understand that when we are making investment in a foreign country, and that is the government of that country is taking certain actions, is a political risk for me. That is Amazon, from Amazon point of view, when they are doing business in India and Indian government is taking certain actions which are adverse for them. Reverse, we understand that when Adani is doing business in Australia and Australian government is taking certain actions which are adverse for Adani. For the financial risk, the interest rate risk, in that borrowing, investment. Next is the currency risk, in which the foreign currency is depreciating. That is the way the first segment is covered. The first segment which was covered like this: identification of the types of the risk faced by an organization. Second was evaluation from investor point of view, from company point of view, and from the government point of view. As far as the investor point of view is concerned, they have provided that whenever investor is making investment in a company which is having the higher amount of the debt financing, then in that case risk for the equity shareholder increases. When the proportion of the debt financing is more, then degree of financial leverage will be more. When debt financing is more, then in that case the financial break-even point is higher. These things we have studied at our IPCC or intermediate level, and because of that, the risk for me as an investor increases. There are more chances that the company will go into the liquidation. There will be an increase in the debt equity ratio. There will be increase in the capital gearing ratio, which is adverse for me as an investor. From the company point of view, exactly the same thing. Higher amount of the debt financing will have more chances that I will go into the liquidation. From government point of view, whenever there is a default by any of the company, any of the bank, or any of the listed company that is ultimately say having a distressed environment in the like businesses, in the investors, and because of that so the for government it becomes difficult to say run the economy properly. So this is what's the risk from the government point of view. There are a number of banks which have unfortunately they have closed down operations suddenly, and because of that, so the number of depositors have lost their money. So, like the people do not have the faith even in the banking sector number of times. We best know the examples of like Vijay Mallya, Nirav Modi, Mehul Choksi. These examples are really like so bad examples, and whatever the tax that we pay to the government, so that is that money is going for so the that is say the compensation of all of them. VAR, this concept has been tested for a number of times in examination, not less than 4 to 5 times. In that say we are having a very good concept. The important thing that say I am discussing, one is that so the VAR is measuring for a specific time period. It will give the conclusion for a specific level of the confidence, loss in amount term or loss in percentage term. So VAR will answer a simple question like this, that what is the maximum loss that I will be incurring in a given time period. That is what the VAR is indicating. That loss may be in the rupees term or that loss may be in the percentage term. It is a statistical method, time horizon. It will give the probability, that is to what extent my conclusion can be wrong. It is useful for controlling the risk, and Z-score is used. That is what we have understood. Application, so you can have maximum possible loss to be decided for the trading position. It is a benchmark for the performance measurement. To fix the limit for the individual's dealing, enable the management to decide the trading strategies. It is asset for the asset liability management for the bank. Its examples we have seen in detail, wherein VAR is calculated by using a simple formula, Z table value, that is Z table reading, multiplying with the value of the portfolio into standard deviation into under root of the time period. This is the way we are required to compute the VAR. That is what we have understood. Evaluation of the appropriate method and identification of the financial risk. So whatever the initially that say they have discussed about the risk, in that say the financial risk they are focusing further. That say how to do the evaluation. That say we are going to come across or we have a possibility that say that kind of risk we will be having. So first is the identifying that if at all something like this happens, then you are exposed to this kind of risk. If at all I am doing business in which I export goods in UK and UK government is considering to do Brexit, then as a company I should be having an idea that say whatever the foreign currency receivable which I am going to receive now, say it will be at a risk, its value is going to fall down. How we can overcome it or how we can have say some solution for that is certain derivative transactions are there called forward contract, futures contract, money market hedge, option market hedge. Those transactions are there, but we understand that say basically I am exposed to that kind of risk. That is what say I should understand. So first is the identification on which they are focusing, and the second thing that they are focusing is on the management. Management means how can you nullify or how can you hedge that risk. So there are 4 risks for which they are focusing. Counterparty risk means you have sold goods on credit and you are not receiving the payment. You have made the advance payment and you are not going to receive the goods. You are given bank loan and you are not going to receive the interest principal. Political risk, in which the foreign, that is say the country in which you are doing business, interest rate risk, investment borrowing, currency risk, if at all you are exported goods, you have imported goods, and the foreign currency. So the hint that may provide the counterparty risk in that say 1, 2, 3, 4, 5. These 5 things are there, and of course your answer has to be to the point, friends. You will see the, of course we are going to go through the suggested answers also, in which you will find that say, they are providing very like the precise answer. So failure to obtain the necessary resources to complete the project or the transaction undertaken, regulatory restriction on the that is by the government. So if at all I have sold goods on credit, and so the government has put some restriction on that company for doing some transaction, then in that case I understand that say, I may not receive the amount which I am supposed to receive from that company for sale of goods. Hostile action by any foreign government, let down by the third party, and insolvent. How can you manage or mitigate the risk? For that, say the due diligence, do not overcommit, know your exposure limit, review the limits for the credit approval, rapid action in case of default, that is performance guarantee, insurance, political risk. In that, insistence on the resident investors or the labor, if at all they do like this, restriction on the conversion, repatriation of the foreign assets of the local government, and price fixation. So how can you mitigate? So these are the methods by which you can have the mitigation. By referring to the political ranking, macroeconomic condition, popularity, embassies. Then further there are additional techniques, local sourcing of the raw material and labor. So the risk for us will reduce. Entering into joint venture. We know that say when Mr. Trump had come as president of United States of America, he had a point that so the companies who are coming over here for doing business, they must make sure that say they employ the local labor, and for the local labor they do not have say anybody say from their own country. Because when Infosys or TCS say have a kind of like an argument with the US government that say we need to hire the people from our own country or from outside America. Why? Because we are not able to say get the good like the employees over here, because we require like the skilled employees. Then in that case say they have a point that say you should, if at all you want to do business over here in America, then you should employ the laborers from America only for the basic work. So do not invite people from your own country. So they had a kind of certain restrictions that if at all you want to have the foreign employees, for them the foreign employees is that is the Indian employees, then in that case you have to give at least this amount of the salary, because as you have told us that they are skilled employees. So minimum amount of the salary is supposed to be paid by Infosys or by TCS or by Wipro if at all they take the employees from India. That is the reason say from these companies point of view, in order to avoid this kind of risk, they may have the more employees say who are foreigners, that is say from the US only. Entering into joint venture, so somebody local partner is there, you have the local financing, so you will be having say the less risk for you. Prior negotiations, interest rate risk, in that say they have only provided that say how can you have the hint of the interest rate risk, that is monetary policy of the government, demonetization, economic growth, industrial data, investment by foreign investors, and stock market changes. Lastly, currency risk. For the mitigation they have not provided anything. In that so the government action, which may be adverse. Nominal interest rate is increasing is adverse for you. Inflation rate is increasing is adverse for you. Natural calamities is again adverse for you. If at all the country in which you have made investment is entering into a war, or local there is say any rebellion, is not good for you. Change, constant keeping on changing the central government is something which is again not favorable. This is the currency risk.